Now the sixth homework set's going to begin with going over some of the principles of how petty cash works here. Again, you'll see most of this set is going to be focused on the bank reconciliation, because that's really the meat and potatoes of most of what you have in that particular chapter there. So first up here, so we got in March, Jarvis Inc. is going to establish a petty cash account for minor expenditures in the amount of $1,000. During the month, the funds diminished to 164, and the accountant's going to tally the following receipts accumulated in the petty cash box. So here we have everything that's been organized by somebody in the accounting department. That's usually who customarily is going to do this. So 389 we can attribute to supplies, 266 to delivery expenses, and the other 175 is just whatever. It doesn't have a specific classification. So the two main prongs here is going to be, first up is the journal entry to establish a petty cash account. And again, all these transactions are going to omit the need of a voucher system. In other words, where you would temporarily, like in a case like this, you would temporarily do what? Put it in accounts payable and then debit it out of accounts payable when somebody pays off the voucher. So we're just doing away with that convention just to sort of, condense what we're talking about here. So all I'm looking for this one would just be the basic two-line transaction right there. Petty cash debit and cash in bank. If it just says cash, those mean the same thing. In some of my handouts and homework, I have reinforced that convention by adding the in-bank phrase after cash. That's all. It means the same thing. Right, so this means that now the $1,000 petty cash fund exists. Right, it's there for use by whoever's in control of it. Remember, that can be more than one individual. Usually you have a system where people sign out for it, so you know who's in control of it at any one point in time if something were to go awry with the fund, meaning if it were suddenly to diminish to next to nothing for no other apparent reason that somebody's stealing from it. We know who's the custodian at that point in time. All right, so that's the establishment of it. Now, the other big thing to understand here is the reimbursing or replenishment of petty cash. Now, again, to reiterate this point from the videos discussing that does not entail debiting petty cash. Again, always want to think of petty cash as a mug. I will attempt to once again draw. This seems to be one of the things I can do in this. At this point, there we go. All right, so we got some 3D perspective there. A really ungainly looking ear going on. There we go. All right, so there's our mug. So again, this is our petty cash fund that we just established for $1,000. Again, it starts out filled to the brim, and in this case, we've diminished it down to just what? 164. So in other words, there's this puddle of cash still sitting at the bottom. Oop, that one got away from me. And oop, that did as well. So again, that mangled circle there represents the $164 is still remaining in the fund. So that means everything above that needs to be refilled. So in other words, we have to refill it up. How much? $836. That's how much it's down by. In other words, you know what the cash credit's going to be here. It's going to be this amount right here. So that's what you can basically plug that in. However, 1,000 minus 164 equals how much it has to be increased by, how much cash you have to put back into it. Because again, it's a mug. It's been emptied, so you're just going to refill it. So you don't have to go and get another mug, the petty cash fund. It already exists. But if you add up your receipts here, okay, you're going to get what? $830. Right, so in other words, somewhere in the process of collecting receipts, something was neglected. So this is all the accounts you want to debit right here. Supplies, delivery expense, miscellaneous. Remember, we need to put it up $836. So what do you do with the odd $6? And I know it's an even number, but I'm just saying because it was just odd in this case, the outlier. You're going to put that in cash short and over $6. Now, we're going to use that plug that we would normally use with cash registers here as well. So the full entry should be supplies debit for $389, delivery expense debit for $266, miscellaneous expenses for $175, plug the $6 to cash short and over, and then a credit to cash and bank of $836. So now once you process that transaction and the money is actually removed from the bank account and given it, donated back to the petty cash box, now the petty cash fund is back up to its original $1,000. And again, it's customary that you should be doing this probably at the end of each accounting period, which we're usually going to define as each month. Now, let's say, for example, you get to the end of the first month of establishing it, and it's only down a few $100s. That might argue for reducing the fund by some amount. So sometimes you might see a contraction there A contraction would just be a reversal of debits and credits here. In other words, you would just debit cash and make credit petty cash for, let's say, $500 and diminish the fund down to just a $500 one. Now, on the other hand, the opposite possibility or opposite problem would be, what if halfway through the accounting period it's down to next to nothing, and somebody in charge of the funds coming to the accounting department saying, hey, I need this reimbursed now before the end of the period? That would argue for doing what? The opposite, increase in the amount of the fund. So maybe it needs to be doubled to $2,000, so you would just do another transaction like this, debit petty cash, credit cash in bank, which would bring the fund up to $2,000 in that example, and then that would now be your baseline for replenishment from here on out. It's getting it back up to its $2,000 mark, not $1,000. So there are occasions where you will use the petty cash account specifically in a transaction, but only if you intend on increasing or decreasing the petty cash fund. Otherwise, it's just going to sit there. All right, now what do you do with this cash short and over account at the end of the accounting period? So let's say at the end of the period it has a $55 debit. Now remember, it's going to be used to plug either cash shortages or overages. In this case, this is clearly a cash shortage. Right? We were short by $6, or we were short $6 at least, you can say, in terms of a receipt or receipts. So you end up with one or the other, either a debit balance or a credit balance, depending on what you had more of. Again, debit balance would mean you had more cash shortages. A credit balance would mean you had more cash overages. So in this case, we have a debit balance of $55. So how should we interpret that? In other words, how's it going to get reported on the income statement? And in this case, it should be reported as miscellaneous expense. In other words, we would convert that balance here and make it part of this account there. Now, all that would entail is just taking that debit balance and crediting it out of their $55 and then debiting it to miscellaneous expenses. So that's all it would entail. Just a quick movement. You just move the amount to another account there. That's all, because it served its purpose. All right, we'll also do part 2 in this video. That's just let you know we've concluded part C there. So we're done with 1 overall. Now 2 was dealing with a series of situations that relate to a April 30th, excuse me, bank reconciliation. So what I'm giving you here is a bunch of situations where these are things that may or may not be included in the reconciliation. And again, your usual choices are going to be, it's either going to be added or subtracted from the bank balance, added or subtracted from the ledger balance, whatever the company's cash balance is, and then the other alternative is it's not shown at all in the reconciliation. So that's what I gave you here, as I gave you these 5 possibilities right there. So the way to analyze this is go through and ask yourself, does this sound like something, again, these are the 2 prongs of what you're working with. Is this something that one of the 2 parties doesn't know about? And does it fit within the time frame of what we're doing here? In other words, within our cutoff on April 30th. So first up, we have checks outstanding on March 31st cleared the bank in April. All right, so these were checks that were listed on the bank reconciliation from the previous month as being outstanding, but now they've cleared the account in the following month. So in this case, is either of these parties on a different page? Is there some information here that one of them doesn't know about? And the answer in this case is no. They're both aware of what's going on. They've both cleared those checks. They've both been accounted for, so that's why it wouldn't be shown. Again, we only care about outstanding checks. Once they're no longer outstanding, they're not part of the reconciliation process. Right now, B, principal and interest earned on a note receivable collected by the bank on behalf of the company. In other words, you look at the bank statement, and so whoever's doing the bank rec is going to see this, how will it show up there? It'll show up as what? Credit memoranda, right? Remember, they're crediting your demand deposit. They're still doing the liability accounting. So they've added whatever the principal and interest are to your bank balance, the company's bank balance, but again, the company doesn't know about it. So again, they're the party that's on the outside of that information set. So that's why that amount should be added to the ledger balance. And again, this column, if you wanted to, again, this is the correct way to, in other words, how is it going to be reflected on your cash balance? That's going to be a debit to cash, right? Because you're adding it to cash. This, of course, would be subtractions. And I know that goes opposite what the memoranda say, but remember, that's because they're telling you the liability accounting, not the cash accounting, not the asset accounting. So always keep that in mind at all times. So whenever you see a credit memo, that means you're going to be doing what? Debiting your cash account. You see a debit memo, that means you're going to be doing what? Crediting your cash account. So it's actually the opposite of what you're looking at. You know, if it were up to me, I would completely change that system so that it was consistent with actual accounting standards rather than that, confusion that they have infused the system with. Now C, bank service charges for April. So once again, you looked at the bank statement, and up is going to show here, it's going to say a debit memorandum. We're debiting your account for $20, whatever the case may be. So how are service charges treated? Again, this is an amount the bank's already subtracted, but you have not, so that would be a subtraction from the ledger balance right there. Night deposit made on April 30th after banking hours. So in other words, this is a situation where the corporation, your company, has booked it. We have more cash. It doesn't show up in the bank statement though. So we're talking about a deposit in transit. So oops, went the wrong way there. Actually, so that should be added to the bank balance because that's something that they don't know about, but you've already accounted for it. Interest earned on your cash balance. This would be another situation where we'd have another credit memo. Here's some money was added to the account. The bank's already done it. You have not. So that's why it's going to fit into the category of a addition to the ledger balance, an amount you would debit to your cash account ultimately when you're doing adjustments based on that set that you just did there. Check written and mailed when? May 1st. What's our cutoff here? April 30th. In other words, this check was written and processed after our cutoff, so therefore it should be nowhere on the reconciliation because it's beyond the cutoff date. Now G, I note that there was a special charge for collecting the note here. In other words, they collected it on your behalf, but it wasn't free. That's usually common. There will be some sort of service charge directly associated to a collection of a note like that. So in this case, that will show up. Basically, it'll be the same as what? The service charge here. In other words, it will be an amount we subtract from the ledger balance. Checks written and mailed on April 30th. Okay, so now that matches our cutoff, and that's a definition of what? Those are outstanding checks. So how do outstanding checks get treated? I went the wrong way again. Subtraction from the bank balance. In other words, you've processed them, they're out of your ledger balance, but the bank hasn't. Obviously, no way they could have processed them because you didn't mail them until the 30th of the month, last day. All right, now NSF checks from customers returned by the bank plus charges for those checks. Just a recap of NSF, meaning that means non-sufficient funds. These are checks that, again, you took from customers, you deposited them in good faith. When they went to the account in question to draw the funds, there was not enough money there, and there was not enough overdraft protection as well. So that's the other thing to keep in mind. When you get a check back, because usually customers have some degree of overdraft, but in this case it was not sufficient. Maybe the amount of the check was beyond that. Like a lot of banks are probably not going to cover an overdraft of hundreds and hundreds of dollars. I mean, it's possible that they could arrange that depending on the magnitude of the account, but for most accounts that would probably be above and beyond what they would cover. So that is why that check would get shot back to you as the one that deposited your business, and it shows up, it's stamped non-sufficient funds, NSF. So the deal is that check has now been subtracted from your balance by the bank, and they've also subtracted some charges on that check. So remember, what's customary is that the customer now has to pay whatever the amount of the check was it bounced, that's the parlance we use for that, plus the service charge on that. So you would reinstate their account receivable for that full amount there. So in this case, the notation should be a subtraction from your balance, your ledger balance, because the bank's already taken care of it, you have not. Right, this one is sort of one I threw in there just to kind of keep things like interesting, mix things up. Check written by the company that cleared the bank, but doesn't appear in the ledger due to erroneous record keeping. In other words, an error was made on our end, the company's end. So how's that going to appear? Well, that's just going to be, you just have to book that check. In other words, it got forgotten, so that'll be a subtraction, obviously, from the ledger balance. K is a deposit made on April 12th, processed by the 14th. So ask yourself, do either of the two parties involved here, the bank or the company you're doing this for, do they differ in the information set? The answer is no. They both agree. Anytime they agree on anything, that's not shown. And then lastly, we have a check. This is what you might encounter. L, check written by another depositor erroneously deducted from the company's account by the bank. This sometimes happens. So what is this going to entail? This would be added to your bank balance, and all you'd have to do, excuse me, is just call up the bank and tell them that, hey, I got this check that's way out of sequence. It's not on my account. It's on an account with a number that's adjacent. That's usually how it goes. It's an adjacent number, and it should not have been subtracted. So the adjustment there is you would add it on the reconciliation, and the bank would, of course, add it to your bank balance as well. All right, so that concludes part 2. Now, part 3 is going to do an actual bank reconciliation. So there you'll see, like we'll go through one step by step, and it'll be a little bit briefer actually we covered here, because this was just sort of casting a wide net. So see you in the next video. Bye.